Oh, all right, guys. Thank you again for tuning into another video. I hope y'all having a blessed and prosperous day. You know how I do on that. Today we got some treats. We got some treats. We got some treats. We got some goodies, and we actually have one of the professionals who are coming in today and let us know a little bit more about life insurance. Oh, sure, life insurance. So they're going to come in and they're going to give us their knowledge. They're going to give us their expertise and show us a little bit how it is going to benefit us if not only we purchase life insurance, but what we can do while we're still alive with certain life insurance policies as well. So he's going to come and break that down, and then we're actually going to get to that. Now, this young man is Mr. Aaron Putu out of Central Texas. Okay, he's been in the insurance game for a little while, a couple years now. He's gotten his feet wet. He has done some good things down in Killeen. So if you're in the Killeen area, make sure you check out Mr. Aaron Mputu, and I'm pretty sure he'll come up with his information as well. He is an insurance broker, and he can help you in further if you decide that this information is good and you want to get some more information. So let's bring up Mr. Aaron. Hello, Mr. Aaron.
Come on, Patience, can you hear me?
Yes, I hear you fine.
Awesome.
Loud and clear. How are you doing today?
I'm amazing, doing great. It's a beautiful day out in Texas. It's not cold finally. So we have very interesting weather. It gets really hot, then it gets really cold. It's just Texas is very bipolar.
Man, that sounds like here. It's desert weather here too, man. Don't feel bad. Shorts in the daytime, sweaters at night. You know how that goes, right?
It is what it is. It is what it is.
I mean, hey. So we want to get into it, man. We don't want to hold you too long. We don't want to hold the people too long as well. We're busy, right? So let's get into life insurance as a whole. Like, can you just tell us a little bit about what it is for the person who may not know, and just give us a brief introduction on what that is for us?
Yeah, absolutely. So many of us, especially in the minority community, what we know life insurance is if something happens to me, which is if I die, then my family will receive a lump sum of money. Right now, we're all taught about that, and the reason why we don't like talking about it is because we don't like to talk about dying. To be honest, especially if you're young, like that's the last thing you want to talk about. Is like, hey, you're gonna die, so you should get life insurance.
Right.
I'm good. Right. I'm healthy. I'm okay. So that's what we're taught. But what people don't really know is that there's so many more benefits. Life insurance is not just about you dying; it's actually about your life, right? Your life is an asset, so you're supposed to protect it. So what wealthy people look at life insurance is a completely different way. You look at it, hey, this is a tax shelter. This is somewhere I can grow my money tax-free. This is money that I can be able to use. And this is something of course, in the event, the two guarantees we have in life, we got to pay taxes and we're going to die, right?
That's true. That
is true. I want to be able to leave my family money. It's something, an inheritance, so they don't have to, struggle like I did, or they want to have a leg up in their life.
Right. That's understandable. Okay. So for the person who is scared to go and get life insurance, because like you said just a second ago, people like I got all my life to live, like I don't want to think about picking out caskets right now. You know what I mean? So what incentives would you encourage those people who were wanting to look into it but kind of just like I don't really, it's an uncomfortable topic, what would you say is something that they could use now?
Absolutely. So this is mainly for younger people, right? Is that what you're talking about?
Yeah. So like a person that's in their 20s, they're not, unless you live a certain type of lifestyle, you're expected to live at least until 60s, 70s expectation, right? So if they're, like you said, in their 20s, they're not thinking about getting life insurance because they're not even, it's an uncomfortable topic. It's something that is widely feared. You know what I mean? Even though people know that it's inevitable, it's still massively feared. So it's like, what would you tell a person who's in their 20s that is like, I really don't think that life insurance is for me because I plan to live this long life, or I just don't want to talk about that right now. Like, Absolutely. How would you smooth that over for them?
Absolutely. So I'm going to give you this quote that somebody gave me, which is really amazing. He said the best time for people to get life insurance is when they don't need it.
Okay.
Right? And why? Why is that? So one, you're young, right? You're healthy, you don't have any sicknesses. You most likely have at least some money that you're able to put away for life insurance, and you're most likely able to qualify for it. So one of the things people don't realize is that the older you get, the more expensive your life insurance is going to be, right? And the worst thing you want to happen is, hey, something happens to you or you get sick or whatever, then it's just like, man, I should have got life insurance when I was younger because it was a lot cheaper.
Right.
A lot of people's like, hey, you know what? I don't want to have regrets. Literally met people who were like 30, 40 years old. And when I taught them certain things when life insurance, like, man, I should have got this when I was younger. So
it's funny you mentioned that, not to cut you off, I'm sorry. It's funny you mentioned that because I remember being in the transition readiness seminar, and that's one thing that they kind of let us know, like, if you get into it now, you only pay this much, but once you turn 65, if you still paying into this, I think it's VGLI, then your premium each month is going to be a lot different than when you paid. And I never understood why that was. So that's cool.
So with the VGLI specifically, the way it works, they call it an annual renewing term. So what that means is that the term policy renews and it gets more expensive each and every other year. So
now, do we know why that is?
That specifically, I'm not too sure. I mean, obviously, I can look it up and find out exactly.
Well, I'm sure it would depend per company, like
Yeah, it's a good policy.
Type. Yeah,
it's a good policy. It's about the government, so they're just trying to make their money. So that's probably what it is. So, but going back to the thing earlier, especially why young people should be able to get life insurance is mainly, I don't look at it, oh, you're going to die, right? It's mainly, okay, what are you going to do during your life? Where's your money going to? Because there's specific types of life insurance that you can get that actually makes you money, right? A lot more interest than just keeping your money in the bank, and a lot more safe than putting your money in the stock market.
All right. Now that's what I'm talking about. That's what I wanted to talk about. How can we use this money to help us make more money?
Absolutely. So I'll give you an example of two very, very well-known companies that would not be here if it wasn't for life insurance. So the first person, you might know him. I don't know if you guys might know him. I don't know. His name is Walt Disney.
Oh man.
Right? So,
are you serious?
Yeah. No, let me tell you the story. So the what happened was the man was flat broke, right? He couldn't get a loan from a bank. He couldn't borrow money. Legit, he had no money. But he had a life insurance policy that was making interest that he actually borrowed money to fund Disneyland.
Oh, Disneyland must have been cheap. Okay.
Hey, this is way back. I don't know when this man had Disney, but this has been around for the longest, right? But he literally had money in a life insurance policy. He was able to borrow that money to start his business. And how big is Disney today? All of us grew up with Disney. We know only one Disney movie.
I literally just looked up a ticket last night for a child. It's $98.
Hey, you know what I'm saying? They trying to make their money. But it would not be here, all right? It would not be here if it wasn't for life insurance. Here's another company that you might know. There's a guy named Ray Kroc, and he took a business from these two gentlemen who started a burger franchise in California. I believe it's called McDonald's.
Wow.
Right. So
McDonald's.
Yes, right. So Ray Kroc actually acquired the business, and as he was expanding, he didn't have enough money to pay the employees. So what he did was he borrowed money from life insurance and then paid his employees, and now McDonald's is all over the world.
That is true.
Right?
Selling all types of stuff.
Hey, they making money. I almost got me a McChicken, yesterday. So I was like, hey,
they say the Queen owns a McDonald's.
Hey, that's what it is. So, but that's the thing I teach people. What people don't understand about life insurance is you can put your money in a place where it's making interest and you don't lose money in there, and that you could be able to use it for your business, for schools, for your kids, for whatever you want to use it for, because it's your money.
Okay. So so we can use this money. Now, can we break down what is this type of life insurance called? How can we, how long does it take for us to get started? Is there a strategy to this, or is it just something that happens naturally? Can you explain that a little bit?
Yeah. So with this specific policy, they call it, it's a permanent policy. So the way permanent policy works, it lasts your entire life. So with permanent policies, there's two different kinds that I also work with. Well, there's actually total six different types of life insurance. I'm going to talk about two different ones. So there's a whole life policy, and there's something called an IUL. The way a whole life policy works, it's a policy that lasts your entire life. So the way
Okay.
permanent policies work is every time you make your payment, your premium every month, a portion
Okay.
goes to the cost of life insurance because it's life insurance. It's not an investment. You're still paying for life insurance.
Right.
And the other position is you're paying for what they call cash value. Now, cash value in life insurance, that's where your money is actually making interest. Now, with a whole life, they have a fixed interest rate, maybe let's say maybe 4 or 5%, depending on the insurance company that you're with.
Okay.
So every year your money is making interest. So that's the good thing about with the whole life is that it's guaranteeing you, hey, no matter what's going on in the stock market, you're still going to make 4%.
So right now, with everything going on in Ukraine and everything, these people who have this life insurance policy, this type of insurance policy, as we
Mhm.
speak, are not losing money,
No,
even
absolutely not.
though the market is like
Right,
dipping
right.
right
Yeah,
now.
it's definitely doing a nosedive right now, right? So
Right.
So with whole lives, no. So that's the good thing with a whole life where it gives you guarantee. No matter what happens, it goes up and down, it stays the same, right? Now with whole life, they also give dividends. So what a dividend is basically money that the insurance company gives you because now you are what they call you're basically a shareholder of the company. Since you own a policy, you own a piece of the company, basically, right?
So,
Just for life.
okay, I got you.
So what happens is if the company is profitable, they're going to share their profits to you, which is goes into dividends. So that goes to go to your cash value, that can go to pay off your life insurance, things like that. So
Okay.
those are the cool thing with the insurance. But here's another thing with it as well. Um, or I'm gonna just transition to a different type of policy. There's something called an indexed universal life insurance policy. So this is
Okay.
also a permanent policy, but it's completely different from a whole life. The biggest difference is with a IUL, index universal life, the cash value is not fixed. It's not they don't have guarantees. The way it
Okay.
works is that just like a whole life, the portion of what you're paying goes into the cost of insurance, and the other portion goes into what they say cash value. Now, the cash value is actually they call it indexed, so it's indexed into like this S&P 500, for example.
Okay. I see what you're saying.
Here's the difference though. Now with IULs, they give you a floor and they give you a cap. So the floor is 0%. So if the market when it crack like it's doing right now, people losing
Mm,
money, you lose 0%,
man.
right? You don't lose anything.
Mm,
But as we know, when the market goes down, does it stay down forever?
of course not. Of
No, it
course
has
not.
to go up at one point, right?
Right.
So on the upside, potentially you're able to make up to, depending on the company, some of them have 10%, some of them 8%, some of them have no cap. It's very interesting that's out there. So
Right.
when the market goes up, your money is actually, you may have more ways for you to make interest. And here's the biggest difference as well, is that unlike, let's say, a 401k or IRA, you don't experience losses. You only experience gains. You either get zero or you gain something.
So you get to follow the advice of Mr. Warren Buffett, huh? Break even,
Absolutely.
huh?
Absolutely.
Absolutely. Hey, well, that's always sounds like a deal. So, well, tell me something. There is because we talk about young people too, right?
Mhm.
And with the life insurance policy of that one can be a little bit more than say the average 20-year-old or 20s to 30s
Mhm.
is actually making or can afford, should I say. Is there any way that they can still get these benefits, life benefits, but
Mhm.
not have to pay a larger amount to get that? Say if they can't afford that, will they still be able to partake in some benefits?
Yes. So with life insurance and now the permanent policy, yes, I will say they're a little bit more expensive than, let's say, a term or a policy or ROP, which I'm going to explain here in a minute. But one of the biggest differences with IULs, it's case by case, right? It with life insurance, it determines your age, your health, if you take any
Mm,
medication, stuff like that. So those are one of the biggest things that these insurance companies look at because if they're going to give a contract to you for hundreds of thousands, if not millions of dollars, they have to make sure, okay, is a person who I'm insuring healthy?
Yeah,
So
is it worth it?
if the healthier you are, the cheaper insurance is going to be, right? So that's why
Right.
people, the older you get, the more prone you are to getting sick. So that's why it's always good for people to at least have something before they get to that point, right?
Right.
So now let's say for example, one of the things that obviously this is not a guarantee, but I can tell somebody who's in their 19 or 20, if they can put at least $100 or let's say $200 into a life insurance policy every month, instead of paying for Jordans, instead of paying for, what I'm saying, eating out every single day, you know what I'm saying?
Come on with it. Tell them one
I'll
more
be,
time.
I'll be going to Applebee's, you know what I'm saying? So it's like,
at least they got
right?
2 for $20.
Hey, you know what I'm saying? Right, exactly. They got those special deals on Fridays, you know what I'm saying? So instead of that, if you save your money properly, of course, you have side hustles, things like that. When you're putting your money in there's something called compounding interest. So the way compound interest works, right, is that there's something called Rule of 72, just to make it simple. So Rule of 72 states it takes the number 72 and you divide that by the interest rate, and that's how long it takes for your money to double. So let's just say, for example, it's let's say 8% or something like that.
Okay.
So if you take 72, right, and you divide that by 8%.
Okay.
Let's see. 72 divided by 8%. Oh, hold on, give me 1 second.
No, fine. I'm sitting here doing it and write it out, trying to remember the rules.
Right. So your money's gonna double every 9 years.
Yeah, I was about to say it's gonna be 8 point something.
Mm-hmm. Yeah. Okay. So every 9 years, your money is going to double.
Okay.
So it's just like, man, okay, dang, that's a lot more than the bank, because your bank's going to give you only 0.3%.
We're not gonna talk about how much they're not giving, because baby, if you wait on the bank to give you the money, you will pay more in fees just to have that bank account.
Exactly. So now, because this is why it's an advantage for younger people to have life insurance. So literally, by the time they're 20, or by the time they're retirement age, they're looking at over hundreds of thousands, if not $1 million, because they have more time for the money to grow and double.
That makes sense. Now, say so if a person, what's the ideal age for them to get started, and at that ideal age, how much would that consist of on a monthly basis? Just average.
Yeah, so for an average person, so if you're talking about for a permanent policy,
yeah, if they wanted to get started on a permanent policy, but say I'm just getting started, I just started my new job, but I think this is a good idea because I think it'll help me move forward. But I can't afford a bunch, but I want to invest into it, but I want it to actually be an investment for something I can use in life and after.
Got you. So a good way, at least if you can do $100 a month, that's good. So that's $25 a week, right?
Okay. I mean, look all the stuff we buy. We can someone in their 20s can do $100 a month. It just is what it is.
$25 a week, you can be able to at least put something in your savings where your money's working for you at that point, right?
That is true.
So that's just on average. And again, this also it is case by case, right? So
right.
One of the things I do want to say as well is that I do want to disclose I am not a financial advisor. I am not a tax professional as well. So if you have any specific tax questions, or hey, where should I invest my money? This is not an investment. Life insurance is not an investment. The reason why it's not an investment is because you don't lose money and you don't pay any taxes. So I do want to disclose that I am a licensed life insurance agent. So just wanted to be able to disclose that. So with that being said, yes, for if somebody can do at least $100 a month, they're just to start, and they can always get something better in the future when they're making more money.
Right. Well, I use the term investment because even if it's something that with just the death benefits alone, it is still a type of investment. Because of the simple fact that say you leave and you don't really have any debt, or you have very little, and it's enough to cover that, plus put in a trust, or something like that you can still leave behind to your beneficiaries. or put it to work for your beneficiaries by starting them out with some type of a lump sum, arrangement. So, I mean, that's the reason I use the word investment. And then also because, like you were saying, that there's things you can do while you're living. You can borrow from it and put it back. So that's why I look at it as like, okay, this is some type of a investment tool, where I can move money around
Right.
and start an infinite banking process, So
Right.
that's, for those people, that's why I use investment. He doesn't use investment, but keep on going, man. Keep on going.
Absolutely. So I do want to one I want to tack on about, if you go to the other picture, or you can leave this one. I'll talk about just the basic ones here, like term life insurance, things like that. So one of the biggest things when it comes to infinite banking, a lot of people now is like really like, oh, I want an infinite bank, I want to become my own bank, things like that. But people don't realize is that it depends on how you're trying to fund it. People think you could just get it and you can leverage it, right? What people don't realize is like, a lot of people who have money, let's say they have $20,000, $30,000, $40,000, they could be able to leverage that concept very quickly, mainly because the way it's funded. This is why it's really important to speak to a professional like myself or my team, things like that, because we want to make sure people can, the life insurance policy is properly structured. You can't just say, hey, I just want to have an infinite bank, and then boom, you got an infinite bank. No, it has to be funded properly, because if it's not properly funded, what could happen? It could literally screw you over financially. Make you
see, now that's important. That's important, and people should know that.
So when people say, hey, I want to be infinite bank, okay, we look at, okay, what do you have? What's going on? How are your assets? What's going on? Can you really afford this type of policy for what you really want to do? Or how do you want to use this policy? So we look at those things to make sure we have a good understanding, so we can be able to properly constructed, so they will not be in a position where their money is at risk because it wasn't properly funded. So when it comes to things like that, if you are curious or how does infinite bank work for me, or hey, if I'm a real estate investor, how can I be able to do this? We can structure those type of policies personal, because again, those ones are case by case. We got to find out, okay, what are you trying to use the money for? There's so many questions that we ask in the process. It's not just as simple as, oh, I got an infinite bank, boom, it's done. There's so much
important. That's important to know for sure. Okay. Any other tidbits?
Yes. So another thing I want to talk about is a term policy, term life insurance. So what a term life policy is. Now, this is, a lot of people don't really like this, mainly because, when it expires, right? So the way term policies works is that you get a life insurance policy for a certain amount of years. So you can get it for 10 years, 15 years, 20, 25, or even 30. Some companies even 35, right? So you're getting it for a certain amount of years. And let's say you have a sister or aunt who's 34 years old. She wants $500,000 of life insurance. Let's say, for example, she's maybe paying about $30 a month. Now, $30 a month, $1 a day to have $500,000 of coverage.
Yeah, that's pretty good.
Pretty good deal, right?
It's pretty good for betting on your life.
Right? So here's the cool thing. The good thing with it is, if anything were to happen to her within the 30-year period, what happens is that the family will get the $500,000, right? Her beneficiary, whoever will do. Now, the only thing with term that a lot of people don't like about is, hey, when the policy expires, when you go over the certain amount of period of time where you got the policy, the coverage is finished. So you're no longer covered. You finish paying for the policy. The money's gone. Right? People don't.
Just poof.
But it's gone. Right?
Just poof.
It's like car insurance. Like boom. It's done.
Come on with the insurance. Somebody gonna be mad about that one, but yeah, you're right. Just
let me give you an example why a term policy is good, especially with the companies I work with. There's something in life insurance called living benefits. Living benefits in life insurance is super, super important. Why? Because you don't have to necessarily actually have to die for you to have to use this money. So we had a client 2 years ago. It wasn't my personal client. She was this, single lady, single mom. She worked as a nurse, and she didn't have any life insurance for her own. She only had life insurance for her job. So one of the biggest differences between having insurance through your job and having your own policy is that when you have life insurance through your job, it's a group policy. Right? 96% of employers will only pay out if you die on the clock. Right?
On the clock. So I got to be at work.
You got to be on their dime. It's either that or if something happens to you outside of work.
You gotta die at work
Yeah.
for
Right.
them to cover your mind. So, okay, how does that work? Like, how are they able to do that?
Because they own the policy. They have their own stipulations. So because you don't own it, you don't have the right to say, hey, this is how I want my policy, this is how much I want. You know, it really depends, especially if the company is really good. Maybe they give you options, but a lot of the times they own the policy, so they can dictate whenever the policy gets paid or not.
Wow. So, isn't that misleading though? Like, because you
Mhm.
have these people thinking that they're covered, to get your life insurance through the policy. I mean, get your policy through the job, whatever. They're paying a little bit out.
Mhm.
Maybe it's cheap because they're getting it through them, whatever. And
Mhm.
then something happens and they can't cash out because it didn't happen at work. So this is basically like paying into workman's comp.
Basically. So like again, definitely check with your employers. But the biggest thing is this: like when people get their benefits through an employee, they're not sitting with licensed professionals. Like
Makes sense.
you go to HR and they say, "Hey, sign right here, you get your life insurance." They're not licensed life insurance professionals to tell you, "Hey, how does this policy work?"
Right. That makes
You,
sense.
you know what I'm saying? It's a contract between the employer and the life insurance company. So they have a master contract where they own that policy. They give it to a bunch of employees, where
Mm,
that's why everybody can afford it because it's cheap, right?
got it.
So that's how that works. Now, the second thing of what's the difference between having your policy through your job instead of having your own is that they only maybe give you maybe 1 to 3 years of your salary. With
One to
studies,
3 years.
1 to 3 years. When study shows that something happens to your family, you need at least 5 to 10 just for them to adjust.
Okay, so I had a friend, right? He
Mhm.
worked for Sears,
Okay.
and he was in he did the appliances, right? Where he
Mhm.
would come out to your home and he would fix your appliances and stuff. And
Right.
he hurt his back on the job. And it's kind
Mhm.
of funny that you mentioned that, because for years this man was trying his best, because he gets like shots in the back, and like he
Mhm.
get like, I don't know what he did. I don't know what happened, but
Mhm.
his back, he cannot work, literally. And I know that happens a lot. But a lot of people
Mhm.
say that, but no, this man, his lower lumbar is jacked.
Mhm.
So he can't lift things and do stuff the way that he used to be able to do it. But the point is, he had to fight, and I don't think he ever really reached a real solution. They tried to settle out a couple times, but they really just tried to lowball him.
Mhm.
And like you were saying, 1 to 3 years. It's actually funny you said about the 1 to 3 years, because I remember this man getting a check for like 45,000, and he was like, "I'm not cashing that,"
Mhm.
because, and that's basically them. Sears was basically just trying to say like, "Hey, take this money, this lump sum, and just leave us alone."
Mhm.
And this was his employer, so that's messed up. First of all, that's messed up. Um,
And here's the thing. I don't know if it was Sears or there was something that was going on. One of the
mm,
companies, I don't know if they went bankrupt or I believe it was Sears. I gotta look it up. But
mm.
basically, what happened was when the company went down, everybody got life insurance or life insurance with them became null and void. They didn't have life insurance anymore.
That
So
happened. That sounds familiar, actually.
yeah,
That happened with another company too. I want to say it was a banking company though.
yeah. Let me see if I can look it up real quick because I believe I have a picture of it.
Yeah, I remember hearing something about that. No, I'm not saying that. Oh, yeah, the specific incident you're referring to, but
Mhm.
I think that happened also with a banking institution where like a bunch of people
Mhm.
had money in this bank or something. Or the
Mhm.
bank went
Mhm.
belly up or something, and they lost everything. Everybody that was a
Yeah.
part of that. Um, in the '90s, I want to say
Mhm.
that happened with some banks.
Or
Um,
2008 too. A lot of people lost money there.
yeah, I see. I'm telling my age a little bit, but yeah, I remember that even as I was a kid. But I
Mhm.
still remember these smaller banks were just like closing down everywhere because,
Mhm.
um, they still do it. I guess have the banks in the grocery stores and stuff like that. You used to
Mhm.
have places like SunTrust and all
Right.
these small little banks that you don't see nowadays.
Mhm.
You just kind of see the big boys.
Yeah. So the company I was talking about was actually Sears. So Sears,
It was serious, okay.
yeah, so you can look it up too. Sears cancels life insurance benefits up to 90,000 retirees. They just cancel their policies.
Serious, but Serious would do you dirty. If y'all work, are they still in business? Probably. Are they
Uh,
still in business?
I don't even know. I don't see it no more. But
I mean,
the fact of
the
the matter
older
is,
generation was keeping them alive, man. They was serious about
yeah, I
buying them
mean, it was different
appliances.
time. Yeah, it was different times. So like even today, like just kind of like going through that, it's like that's one of the biggest things. Like even what happened in 2020 when the shutdown happened, a lot of people lost their jobs, so they got laid off.
Right.
Right. So what happened was, people lost their jobs or they quit or they got fired or whatever. But what happens is
Mhm.
when you leave your employer and for any reason, that life insurance policy becomes void. So you no longer have insurance anymore.
Poof.
Right.
Man.
So when the client heard that, we told her that. And so she got approved for about 250,000 for about $30 a month.
Oh,
So
okay, that's good.
So she got approved. Now with the life insurance, you got to be healthy, right? So she checked out. She was really healthy,
Mhm.
and everything was really good. So now after that fact, what happened was 4 months into her having the policy, what happened was she got diagnosed with breast cancer in 4 months. I'm
Okay. Wow. Now, is there a stipulation on? Well, because she had her screening and she was healthy. That's
Yeah,
why.
she was healthy. So they didn't. There was no like she didn't have a history of cancer or
Right.
anybody in her family. It just literally 4 months something just happened and she got cancer. So because she kept that $30 a month of policy, the insurance company paid her $250,000
Now they gave her that as a cash benefit.
as cash. So that's her money. So she paid off her. So it wasn't like
Wow.
it's not like a medical benefit where it's only for your medical bills. No, she paid off her medical bills. She paid
Mm.
off that extra money she had to pay off her car. She paid off part of her house, and she still has money left over for retirement.
Oh man.
And that's a term. That's a $30 a month policy. When people say, "Hey, oh, term, da 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 da," I mean, I get it, but if something actually happens, you get sick, like you have cancer.
Yeah, like I'm not gonna lie.
Mhm.
If a person would have, if a person was of a certain age, right,
Yeah, she
and
was
they
30.
wanted to get a term life insurance policy, I can understand it. If you're 50, 60 years old and you don't see life for another 30 years,
Mhm,
I can see you buying it. You know what I mean? It sounds
mhm,
crazy for a young person to do, but
mhm,
especially for your money just to vanish, you know what I mean? Just like
mhm,
poof. But um for an older person, like say if they were, I don't know, 40, 50,
mhm,
I could see them doing a life, or maybe a person, you know, how people like, oh, well, you know, people in their family all kind of croak around the same age, or,
mhm,
you know, something like that. I could see those people maybe possibly, or if they have a family history of something
mhm,
that just hasn't shown up yet because you're not old enough yet.
mhm.
Um, I guess. I can see how it's a little weird for people to be like to
Right.
even want to think about it, you know. But that's a good
But
night. That's a nice payment per month, though.
yeah, so the thing is this is like, life is never gonna guarantee. And I'm not trying to be
Right.
like a doom and gloom, right? This person was 32. She was young,
Yeah.
right? And it's just like I even have people who even in other cases when they were 20 and something happened, they got sick and they passed away.
Yeah.
We don't expect, and that's not like, we're young, we're not invincible, we're still human beings. Things happen. And I'm not saying,
Yeah.
oh,
Things happen. Yeah.
right? But it's better to be safe than sorry. It's better to have something. It's better to have something when you don't need it than rather than not having it when you really needed it.
No, of course. I
You
agree.
know,
I agree. Yeah.
and in the way that I educate people about it, like term is not the end all be all. Term is just for at least having something now. So of course, when you're making more money in the future, you can look at something that's a little bit better.
Hmm. That
So
makes
that you
sense.
can be in that different position. So those are the things that we really educate clients on. Hey, like for me, I have both. I have a term and I have a permanent policy. I have something that's going to protect me when I have my family, when I have my kids, things like that. My family, my mom is going to get, X amount of money. And then I have my
Hmm.
own policy where it's making me interest over time.
Okay. Okay.
Even for me, and I'm only 25.
Hey, I mean, you gotta play the game, bro. I keep trying to tell people it's all a game. It's a bunch of different games, and it all comprises together to make the game called life.
Mm-hmm.
You know what I mean? So, wow. Well, that's what's up. Let us know where we can find you on social media if we want to get in touch with you or get some more information. How we can do that, and we're gonna go ahead and wrap this one up.
Absolutely. So you guys can find me on Instagram at Aaron Aaron .mputu MPUTU. You can find me on Instagram or TikTok as well. I'm doing my little TikToks, making a little fun interaction for you guys. Same handle, Aaron Putu. Or you can also find me on Facebook, same handle, Aaron MPUTU. You can find me on Facebook as well.
All right. Well, thank you so much, Aaron, for coming through, dropping some jewels, dropping some knowledge on us. Thank you for definitely coming in and being a guest with us today. I definitely appreciate that. And it just makes it so much easier when we can get the information out, educate the people, and not have to try to learn everybody's, different things. So I do appreciate all your participation. So we're going to wrap this up, and you guys check out the description box. I always have some goodies in there for you to check out. You can also check out the the website if you need any assistance on the financial end. If you're wanting to get in touch with Aaron, we're going to also put that information in the description box as well. So check out the description box. There's always goodies. There's always incentives inside of there. And other than that, we definitely want to thank you for tuning into another video. Peace.
Thank you.
All right.